With the congressional approval of the $1,900 billion American Rescue Plan, the United States has taken another important step towards economic recovery. Together with the successful vaccination campaign, this unprecedented large fiscal stimulus plan should ensure a rapid and strong recovery of the American economy this year. The impact of this stimulus will not only be limited to the US, it would also have an impact on the global economy. A recovering US economy will support global export demand and thus the global economy with the most important trading partners in the front row. However, this will not be enough to pull the European economy out of the doldrums. In other words, additional budgetary support remains necessary in Europe. Nevertheless, Biden's plan cannot count on praise from everyone. Some even speak of unprecedented and irresponsible budgetary experiment in which excessive stimulus could lead to an overheating US economy and derailing inflation. We assume for now that the US economy will transform additional stimulus into economic growth without any persistent derailing of core inflation. Indeed, let us not forget that the US economy has available production capacity and that the labor market is sufficiently flexible to absorb the additional demand, just as it was the case before the crisis, in fact. However, inflation risks remain on the upside, especially if Biden's proposed $2,000 billion infrastructure plan does not lead to supply-enhancing investments. And closer to home, well, additional fiscal stimulus is also being prepared in Europe. By extending the escape clause of the Stability and Growth Pact, the European Commission opened the door for additional national budgetary support. And according to the original timing, the financing of national investment plans via the Next Generation EU Recovery Fund will be rolled out from the autumn onwards. For the time being, however, we must await the ruling of the German Constitutional Court on the legality of this plan. A negative outcome could lead to great uncertainty at the European level, with a significant impact on a number of southern and eastern European countries. Apart from this risk, the question remains whether the budgetary policy in the EU will be sufficiently supportive or whether it will turn out to be too little, too late. As far as economic growth is concerned, we are still penciling in global economic recovery in the course of this year. However, differences in fiscal policy and vaccination pace are causing increasing divergence in both the timing and the intensity of that recovery. We expect the Chinese economy to outpace its pre-crisis growth rate with a growth of 8.5% this year. And for the US, we expect a historically high growth rate of 6.2% this year due to a rapid reopening of the economy and the fiscal support. And with this growth rate, the US would not only reach the pre-crisis GDP level this year, but it would also return to the original pre-crisis growth path. And this would keep the ultimate losses from the pandemic relatively limited. Meanwhile, the extension and in some cases even the tightening of lockdown measures continues to weigh on the European economies, leaving them lagging behind. Still, we expect an economic revival in Europe with positive growth for this and next year, and for the Eurozone this would mean a growth rate of around 4%. Recent real-time indicators, such as the PMIs or sentiment indicators, point to increasing economic resilience and thus less damage from the prolongation of lockdowns. Moreover, the recent acceleration in the pace of vaccination raises prospects of a gradual reopening of the European economies from the second half of the year. But caution is still warranted. The European recovery remains heavily dependent on the acceleration of vaccination, on fiscal support, and on external demand. Risks to European growth therefore remain clearly on the downside. We will also be watching inflation developments closely in the coming months. Inflation and inflation volatility are set to increase in the major economies this year. The flash estimate for March suggests that headline inflation in the Eurozone rose by 40 basis points to 1.3%, a preview of things to come. Indeed, a number of temporary factors point to further increases. Following the historically low prices last year, the recovery in oil prices will push inflation even higher in the coming months. And in addition, a number of cost push factors also play a role. Rising commodity prices and disruptions in global supply chains, such as the semiconductors or shipping containers, are causing temporary upside price pressures. And the result is a higher inflation pressure worldwide. We expect average inflation this year to be 2.6% in the US and 1.6% in the Eurozone. However, this temporary surge in inflation does not necessarily mean that inflation will derail. Output gaps remain substantial in most economies, so that expected economic recovery will not necessarily be excessively inflationary. For the time being, we expect inflation to remain structurally in line with central banks' inflation targets. Slightly above 2% for the Fed and below but close to 2% for the ECB. The same central banks have also responded clearly to the recent developments in financial markets. Indeed, the abrupt rise in nominal and real interest rates in bond markets confronted central banks with the important choice of either accepting or neutralizing these rate increases. After March policy meetings, the difference in views between the Fed and the ECB became clear. While both confirmed their supportive monetary policy stances, the Fed appears less inclined to oppose orderly rate increases, provided, of course, that these are in line with economic recovery and the progress in vaccination. The ECB, on the other hand, accelerated its purchases through the so-called Pandemic Emergency Purchase Program, or the PEP program, in order to neutralize the tightening of the financing conditions. And these different views will continue to play out in the current year and could lead to further divergence in long-term interest rates, with temporary euro weakness as a result. In summary, we continue to expect a global but not synchronized economic recovery. China and the US will take the lead, with Europe lagging somewhat behind. Headline inflation is picking up as expected, and central banks are reacting differently to the recent interest rate developments. But let us not forget that the rollout of the vaccination campaigns, together with fiscal stimulus, will remain the main levers for the coming months.